Welcome to vTalkInsight, Market Drivers Daily for December 5, 2025. AI spending, shifting rate cut expectations, and a surprisingly resilient growth backdrop are pulling markets in different directions, creating both dispersion and opportunity across asset classes. The AI story is moving out of its pure hype phase and into a tougher stage where capital efficiency, monetization, and balance sheet risk matter much more. Consumer adoption of AI tools has exploded, yet most users are still on free tiers, so digital advertising remains the main revenue engine while direct willingness to pay is limited. On the enterprise side, sizable AI revenues from business clients are now widely expected to arrive only from 2026 onward, as pilots and proofs of concept slowly convert into full deployments. That delay in monetization is already creating clear winners and losers in public markets. Salesforce has eased investor concerns by reporting stronger earnings, raising guidance, and highlighting rapid uptake of its AI agent by around 9,500 firms, which has helped its shares and sentiment around incumbent software names. In contrast, Snowflake has sold off sharply after disappointing margin guidance and underwhelming AI profitability expectations, even while announcing a sizable partnership to enhance its cloud AI capabilities, underscoring how investors are now rewarding tangible economics rather than headline deals. Large platforms are also repositioning around AI with very different risk profiles. Meta is cutting spending on its metaverse ambitions and reducing headcount in its Reality Labs division, redirecting capital toward AI and augmented reality, which markets have welcomed through a stronger share price. At the same time, Meta faces fresh antitrust scrutiny in Europe over AI features in WhatsApp, and regulators there are still debating whether to use traditional competition rules or newer digital frameworks, adding uncertainty to how AI services will be governed. Regulation is not just a European story. In the United States, fragmented state-level AI rules and the lack of a single federal framework risk raising compliance costs and diverting resources away from innovation, potentially eroding the country's pacing edge versus global rivals. On the geopolitical front, U.S. lawmakers have pulled back from new restrictions on advanced AI chip exports to China in the latest defense bill, removing an immediate overhang for NVIDIA and similar names, even as Chinese players like Cambridge can ramp production to fill gaps while still trailing U.S. peers on technology and software ecosystems. Under the surface, the funding model for AI is changing in ways that matter for credit markets. What started as largely cash-funded hyperscaler Capex is evolving into a cycle where up to $3 trillion of AI infrastructure spending through 2028 is expected, with roughly half financed by debt. Highly rated tech companies are already issuing substantial bonds at relatively tight spreads, and banks such as Morgan Stanley are actively transferring risk from large data center financing books, signaling early concern about concentration and potential credit losses if expected productivity gains fail to materialize. The physical side of AI remains in an early expansion phase, but investors are debating sustainability. Rapid data center construction is being met by equally rapid demand from AI use cases, suggesting the sector is still far from oversupply even as some industry leaders worry the current build-out may prove excessive or speculative. On top of that, a coming wave of bond issuance from energy and utility companies to meet AI-driven power needs and grid upgrades, alongside heavy issuance from large-cap tech, points to structurally higher long-term funding requirements for the ecosystem. The labor market is another fault line in the AI narrative. Demand for AI-related skills is surging, with job postings requiring this expertise rising sharply year on year, and AI is increasingly seen as essential for sustaining growth in sectors from healthcare to agriculture and real estate. Yet entry-level roles are being cut at major banks and consultancies, recent graduates face much higher unemployment risks, and policymakers warn that mismatches between disappearing jobs and new vacancies could fuel populist backlash if retraining and mobility are not addressed. All of this creates a complex balance between bubble risk and genuine productivity upside. On one side sit worries about circular financing, stretched valuations, heavy AI-related bond supply, and operational vulnerabilities highlighted by events such as data center outages delaying major securitizations. On the other, evidence is building that the current infrastructure build-out is delivering revenue growth and cost savings more quickly than the early internet era, with sectors like film production, retail, and industrial infrastructure already reporting tangible benefits. For allocators, the key watch points are execution and cash flow, who converts AI adoption into sustainable margins, how credit spreads absorb continued issuance, and whether regulation or politics become the next constraint. The rate story is dominated by expectations of an imminent Federal Reserve cut and a broader easing cycle, but the longer-term path looks far less certain. Weaker U.S. private payroll data, including the largest drop in private sector jobs since early 2023, has pushed market pricing to view a December cut as almost a done deal, supporting rallies in global equities, small caps, and even crypto. Recent readings have been soft enough to validate calls for easier policy, yet not weak enough to trigger outright recession fears, reinforcing a soft landing narrative. The debate now is less about the first move and more about how far the easing cycle can realistically run. Market pricing for multiple cuts over the next year, sometimes 4 or more, sits alongside forecasts for U.S. growth around 2.25% next year and inflation still hovering near 3%. Several Fed committee members already project a terminal policy rate below 3%, signaling a tilt toward more dovish settings, but other strategists argue that strong growth, fiscal expansion, and AI-related tailwinds could limit the case for aggressive cuts. These cross-currents are visible along the yield curve. The spread between 2-year and 10-year treasuries has moved into a persistent steepening pattern, with the front end anchored by cut expectations while longer maturities struggle with rising term premia, heavy government deficits, and a surge in both sovereign and tech sector bond issuance to fund AI and other investments. Front-end yields remain relatively attractive on a carry basis, particularly if the Fed does deliver on anticipated cuts, yet any disappointment on the scale of easing could leave longer-dated yields higher for longer. Policy credibility and leadership are adding another layer of complexity. Speculation over future Fed chairs and court decisions involving policymakers has contributed to a weaker dollar, with bond markets reacting nervously to the idea of a structurally more dovish central bank. If future rate cuts are perceived as politically driven rather than data-driven, investors worry that long-term market rates may decouple from the policy rate, the dollar's safe haven status could be questioned, and dollarization narratives could gain renewed traction. Outside the United States, policy divergence is likely to become a key driver of cross-asset returns. The Bank of England is expected to cut more aggressively than current pricing implies. Sweden's disinflation and pockets of European weakness could prompt additional European central bank easing, while in Japan strong demand for long-dated government bonds sits alongside expectations of at least one rate hike. Against that backdrop, forecasts of a weaker dollar built on lower U.S. rates, balance sheet expansion, and even a form of stealth quantitative easing from Fed reinvestments will need to be tested against actual policy decisions and incoming data. The immediate focus is next week's Fed meeting, but the more material questions for portfolios are how many cuts follow, how the curve behaves as issuance continues, and whether currencies become the main shock absorber. The growth backdrop continues to surprise on the upside, even as headline sentiment remains cautious. Over the past 2.5 years, U.S. GDP has averaged close to 3%, with consensus forecasts persistently undershooting by roughly 1 percentage point a year. And the latest projections still see growth around 2.25% next year rather than a downturn. Looking further ahead, 2026 is expected to bring stronger U.S. growth again, supported by tax incentives, regulatory relief, and large-scale infrastructure spending for AI data centers and power. Much of the optimism rests on an investment-led expansion centered on AI and energy infrastructure. Upward revisions to capital expenditure expectations suggest Capex alone could contribute around 1 percentage point to U.S. GDP next year, while companies like GE Vernova and Vertiv are reporting strong backlogs, rapid organic growth, and margin expansion tied to grid upgrades and liquid cooling for data centers. In Europe, capital goods firms exposed to power generation and AI infrastructure, including key technology suppliers, have received analyst upgrades and are expected to outperform through 2026 as demand for electrification and computing capacity ramps. Growth momentum is not confined to heavy industry. Consumers are showing a willingness to pay premium prices for time-saving appliances and services. Global theatrical box office numbers are setting new records, and platforms such as Formula One are attracting a larger, younger, and more gender-balanced fan base, broadening the appeal for sponsors and consumer brands. Companies in travel, beauty, and animal health are pursuing multi-pronged expansion strategies, from airline mid-cycle upswings and new store rollouts to pipelines of innovative treatments that could open billions of dollars in additional addressable markets. AI sits at the center of this growth story but also shapes its main risks. Investment in AI is viewed as a key driver of U.S. resilience, with expectations of higher productivity and wider corporate margins across many sectors over the next 5 years, and demand for AI skills rising rapidly. At the same time, persistently weak indicators in parts of the labor market, including small business job shedding and stress in junior roles, raise the possibility that mismatches and displacement could dampen consumption or spark policy responses that alter profit dynamics. On the financing side, yield prospects for both liquid and private credit remain attractive into 2026 under a base case of growth reacceleration, but a heavy pipeline of AI-related and infrastructure issuance leaves little room for disappointment on returns. The net picture is a world where upside growth surprises remain plausible, yet the distribution of outcomes is widening. If AI Capex, fiscal support, and infrastructure build-outs continue to translate into realized productivity and earnings, forecasts could again prove too conservative, supporting risk assets and keeping default rates contained. However, an abrupt correction in richly valued U.S. tech, a sharper slowdown in employment, or evidence of AI overinvestment would pose meaningful headwinds, potentially forcing central banks to choose between tolerating higher inflation or risking a harder landing. For now, the key indicators to watch are Capex realization in earnings reports, sector-specific demand for power and connectivity, and how quickly the labor market can adapt to the new skill requirements implied by this growth model. To sum up, AI is entering a more demanding phase where scale, execution, and funding discipline will separate winners from also-rans, even as the technology remains central to medium-term productivity and earnings. Rate markets are firmly focused on a near-term Fed cut, but the depth of the easing cycle, the behavior of the yield curve, and the credibility of policy will be crucial for bonds, credit, and currencies. And despite visible soft spots, the broader growth story still leans toward investment-led resilience into 2026, powered by AI infrastructure, energy, and targeted consumer demand, but with higher sensitivity to policy mistakes and valuation shocks. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.